Let's have the panelists introduce themselves.
Thank you so much, Minnie, for hosting us. Thank you so much for being here and taking the time. My name is Danaé, and I'm an investor at One Ventures. At One Ventures, invest in early stage companies, in deep tech companies that have superior unit economics and that is net positive to nature. I personally have a background in green chemistry, so it helps me today with understanding these technologies and analyzing them for adoption. Thank you.
Thank you all for coming out on a pleasurable rainy day in Los Angeles. We need more of those. My name is DC Paltor. I, like Minnie, am part of the TCA Venture Group. I'm also in another group called Chemical Angels. Both groups invest in early stage startups. I started off as an energy engineer a long time ago. Mostly worked in pollution reduction in steel manufacturing in Japan. Ended up working on General Motors charging infrastructure for the EV1, if you remember that long ago. Some of you have enough gray hair that you might remember that vehicle, so I was involved in the charging infrastructure on that. Ended up coming back here to UCLA, getting an MBA, and working in computer networking startups for 25 years. So it's been startups, and now I wanted to get back into startups involved in solving the energy crisis. So I've been mostly an angel investor in early stage startups with a focus on sustainability, but I've also been a very active mentor working with startups in the space and in some of the accelerators. I also write articles on a weekly basis for startup founders of what it is that our investors are looking for and how to get your startup off the ground. Thank you.
AeroVironment brought me to Southern California with the EV1, so that's how I came here. My name is Fyke. I'm the founder and managing partner at Thin Line Capital. Thin Line Capital is a pre-seed, seed stage VC fund that I started to invest in clean energy and climate resiliency companies. I have been active in the climate change industry since 1994 when I presented to the World Hydrogen Energy Conference. And I've started my career with fuel cell vehicles, worked to electric vehicles with EV1, and then eventually became an entrepreneur. I started 6 companies in the clean energy space. 2 went to zero, 2 did okay, and 2 became unicorns. And then on the back of that success, I was able to start Thin Line Capital, and now I invest in companies that I describe it as primarily take market risk rather than technology risk, just because of the size of the fund and the check size I can write, which is typically $400,000, $500,000 into various rounds. And then I have a very concentrated portfolio, and I'm very active with the companies I invest in because what I bring to the table is as a prior entrepreneur, which is different from some VCs who maybe have a banking or a legal background. So yeah, that's what I'm doing here today.
Cool, impressive. I mean, this is the one of the best panel I'm getting involved. So thank you very much for coming. My name is Shih. My background, I undergrad in physics and get my degree, another degree in electrical engineer, and run into different companies from the medical, energy, material, and the defense. So. Do a lot of different things, and then I went to the dark side and get my MBA from UCLA Anderson. Whatever related to the energy side, actually I personally involved with some project right now in the Imperial County, which is called Lithium Valley. So if anyone interested in knowing more around that area, that we can talk or get connected as well. All right, let's kick off this panel. So. It's interesting that we're seeing a lot of technical presentation today, and I'm just wondering, maybe we turn the table around a little bit and just say, from the investor point of view, what have you seen? What's a new trend? What's a hot right now, or what's cool? Not hot, what's cool right now? Any one of you?
There are trends in the industry. When I started, I was designing fuel cells, and which I would call clean tech, 0.1. The first clean tech boom was probably the 2006 to 2009 timeframe. But before that, there was a company called Ballard Power Systems in the 90s that hit an $18 billion market cap developing fuel cells. And so much money went into fuel cells, and so much excitement was, fuel cells were going to make Ballard, this company that I worked for, the Intel inside of the auto industry. And it never materialized. Battery electric vehicles became far superior, and fuel cells didn't succeed. And unfairly, I think, poisoned that industry from a point of view of investment. When you have something that has failed across a wide swath of investors, then even if there are good things that can come out of it, it's hard to get new investor capital. So there are waves. Biofuels was one. I think what's different this time around is that, at least in the first clean tech boom, this was the one called clean tech, whereas the phrase that's used now is mostly climate tech, or actually climate tech seems to be the one that's stuck. But everyone is using venture dollars to back things that shouldn't be backed by venture dollars. So the solar industry, the wind industry, these industries grew eventually by project finance money and corporate banking money, but it was a real mistake to use venture dollars to apply to it. Solar, wind, battery storage, electric vehicles, these markets are all large enough now that there are companies that are selling into those markets, which are good VC investments, as opposed to trying to use VC dollars to build out the solar industry in the first place. And so what I'm seeing are a lot of supporting companies, a lot of, the phrase that's used in other industries are picks and shovels. I'm not investing in the gold mine, I'm investing in the companies that are selling things to the gold miners. And so UCLA wants to manage their fleet infrastructure. I've invested in software companies that help fleets figure out how to plan out EV charging, that kind of thing. I'm not going to invest in a new EV company, but I'll invest in a battery company that does data analytics for battery manufacturers. So all of these supporting roles, that's what I'm seeing as really common, because the market is big enough. 15 years ago, the solar industry wasn't even big enough, much less a company playing a supporting role to the solar industry, and that's totally changed.
So I actually invested in Ballard at the height. That was not one of my
2001.
Yeah, sometime around then.
Yeah. Okay.
Yeah, I think I got about.
You might have paid for my grad school. I appreciate that.
So, Minyi, if you had asked me this question 3 years ago, the answer would have been easy. Batteries. It was batteries, batteries, batteries. We saw new battery chemistries. We saw, lithium-ion batteries. We saw flow batteries. We saw, new anodes, new cathodes, new separators, new manufacturing techniques. That's kind of died off. There's, as Aaron said, there's these waves, and the fact that, talking about cold, we just had Northvolt go through bankruptcy very recently, and suddenly all the investors are like, batteries, oh my God, no way, we're going to lose money, whereas 3 years ago it was like, well, how can we give you money faster? So we still see batteries and the supporting role, how we make the current batteries either more efficient or less expensive. It's tough though, because most of the manufacturing is in China, it's kind of gotten away from here. But we still see some batteries outside of climate tech. The answer is easy. AI. It's, in the big macro, it's AI. In the little micro, it's AI for this or AI for that. And so we do see some of that. So now it's AI for mining. It's AI for chemistry. It's AI for finding, the best electrolytes. But that's we see a lot more of that outside of climate tech. So in climate tech right now, I don't see an overwhelming trend yet. So we're seeing a little bit of this, a little bit of that, a lot of how we replace chemicals that are currently made with petrochemicals, how we make them with agricultural waste, how we make methane or ammonia with bacteria instead of large chemical plants. So I don't see an overwhelming trend at the moment, but a lot of interesting new technologies that are coming out of scientific advancement, scientific research that bit by bit can make a big difference.
I completely agree with both of you. And Aaron, the cycles you were mentioning is very much key, and I think we need to be aware that what's hot today is usually not hot at all tomorrow. And a good representation of that is actually the Gartner cycle. I don't know if you've heard of this, which is very representative of these waves. And then DC, completely agree with you in terms of AI, and that's what I would like to talk about today, because I do think that there is correlation between AI and climate, especially where in more traditional industries, as well as very much repetitive actions, or in space where there is a lot of trial and error, AI is going to be very beneficial. We at One see it as a catalyst for solutions, so it's not going to directly bring solutions, but it's going to provide data in order to accelerate the change for the positive environmental impact. Another one is data centers, which is highly correlated with AI, and I think we're doing in general a really good job understanding the problem that comes with AI. In innovation, that's not always the case, and that's something I would always recommend. When there is a hype, always think about what are the potential problems with that. But again, that being said, I think we're doing a good job. But maybe we are lacking the understanding of what these solutions mean, because they're not very sexy. We're talking about HVAC solutions, we're talking about concrete and cement alternatives. So again, I think we are at a hype around AI, and data centers. It's going to become more and more of a problem very quickly, and so we need to invest in these technologies today.
So let me ask that if you can say yeah, nay, right? How about nuclear?
Yay.
Yeah?
We invest in a few.
Okay. And how about carbon storage, capture?
Sorry, yay or nay for what?
Yeah.
Is it a hot trend?
The trend right now, we passed the peak of the carbon storage and the capture technology.
I don't think we've passed the peak on that.
No,
still.
we haven't solved it yet.
No, I don't think so.
No, and
All right.
and there's a big need for it. So I do see a lot of people working on that.
Yeah.
Fusion was huge last year. I was mentoring a startup in the fusion space, and there's a lot of them out there from various universities, and I think there's still some big money thrown at that, but it's like the company I was mentoring needed to raise $100 million for their prototype, and I'm like, you're not going to come pitch to our little Tech Coast Angel group. You're going to have to find some big money somewhere, probably from the Department of Energy,
which might not be very helpful right now.
Yeah.
Yes. Fusion's a weird one because one of the risks that I have to underwrite is because my fund is not big enough to back a company all the way to the end, is what is the probability that they can raise their next round? Because if I put in money and no one else will invest later, it doesn't matter how great it was, they smash into a wall and it's all over. And Commonwealth Fusion Systems literally made the engine's, MIT's fund, all of their returns. I mean, it's like, I think their last raise was like a $13 billion valuation. So, and so I kind of marvel at that because I think, man, if I didn't invest in Commonwealth Fusion, it's out of my thesis, it's everything I wouldn't do. But it doesn't mean it's a bad investment, it's just not what I can do. I wonder, like, you're doing diligence on the technology, but you're also trying to guess, is this the team that can raise $1 billion? And that's sometimes really hard to figure out. Like, I mean, the team you're talking to might be all those things they should be, but they personally don't know Jeff Bezos because, not everyone knows Jeff Bezos. And so they can't raise $100 million. And so those are sometimes it's like, it's a weird paradox of it. It's not like there's a lot to diligence beyond just the quality of the company of whether it'll succeed or not. And fusion amplifies that.
All right. Then, so no cold fusion then.
Oh, Cold Fusion pitched to our group a few years ago.
Okay.
No.
Yes.
No.
They're still out there trying. I mean, it's a different group that's licensed the tech. Anyway, we can get that over beer.
Yeah, it maybe the two words not meant to be together at the beginning with. Anyway, so I mean, this is a good transition. That so now there's a trend. You invest in a certain interesting area. So if people want to fundraise, if they approach you, right? What should they do? I mean, I think a lot of audience may be curious as they say, okay, I have a great idea. Then how I approach you, and what is the right way to do? Maybe you can, share some of your insight. Maybe start from DC and then you can, yeah.
All right, so I mentor a lot of startups, and especially in the academic world, but even outside at accelerators. And outside of climate tech, they're all pretty clear. They want to raise $2 million to build their product on a $20 million valuation. The ones in climate tech, they need at least $5 million, sometimes $10 million. So they're like, okay, so who can I raise $10 million from at a $50 million valuation? And my answer is nobody, unless you have connections. You're not just going to go on LinkedIn and start hitting up investors for your $10 million round or even your $2 million round. And a lot of them don't want to hear that. They're like, oh, I read about somebody who knew Jeff Bezos and invested $10 million in his business. And I'm like, okay, well, then if you've got that connection, go talk to Jeff, don't talk to me. It's hard because what investors want to see, unfortunately, is traction. They want some sort of, proof that what you have is actually going to work. And so you've got this split between the people who invest pre-revenue and the people who invest post-revenue, or at least kind of post having a finished product MVP that's out in trials with customers. And for software is so much easier, right? You get $1 million, maybe even not that. You put together some friends, you work on nights and weekends, you put together some MVP, and you go take it out to a few customers, and some of them say, yes, we'll sign up for your trial. Some of them might even pay for an early stage version of it. And then you can go out to investors and say, hey, look, we've just signed up these customers, they love it, and here's our path to $100 million. With climate tech, especially now, I mean, AI and software does qualify as climate tech, but I'm referring to the actual chemistry materials, the hard side of it. You generally need $2 million for your bench tests. You need $5 million for your scalability tests. You need $10 million till you can get to some sort of a prototype of something you can actually start bringing to customers. And investors are wary about putting in money before you've actually proven that it works. So finding those early stage investors is a very big challenge, and it is this chicken and egg problem. And it's not going to be the people who are like me that are advertising themselves as being angel investors or VCs. It tends to be it tends to be friends and family. It tends to be people in your network. It tends to be potential customers, and then grants, government grants, SBIR grants. You can get $5 million that way to put together your ability to get to commercialization, and then you can go to an angel investment group. You can go to a small VC and say, hey, look, we use the grants. We proved that it works. Now we need money to actually start building the real factory, or at least building out a more volume so that we can start sending samples out to customers. But we've got trials with these three customers. They loved it. They loved it so much they invested in us. So any kind of hardware-based product, and we really see it in climate tech, is a huge challenge for for getting started, and it's really not going to be just going to on LinkedIn and look or getting a list somewhere from PitchBook of a list of investors. You really need to prove the product before you can start talking to those more generalist investors. So it's going to be people who are specialized in your world already that are going to help you through that first stage. You guys agree?
I agree. No, I think you're completely right. There are two things. One is network, and I think you touched on that. And the second is timing. And I think I'd like to touch on that a little bit more. What I would recommend is reaching out to that network as fast as possible. What I mean by that is you want to raise as quickly as possible because you want to create a hype around your round. And something you might not know is that investors talk. And so, for example, DC is going to come to me and say, oh, we talked to this company last week and I received an email from them, and I'm going to want to talk about them even more because I have FOMO. I want to make sure that I talk to this company and I don't miss out on this opportunity. And on the contrary, if a company has been raising for over 12 months, it's going to show some flags. Is it because of the team? Is it because they were not prepared? Is it because the technology is not good enough? If other investors are not interested, why would I be interested? And so you want to create that hype, that momentum around your raise, and that is going to be very powerful in terms of also how much you want to raise.
And your problem about hardware is a really good thing to point out, and that's why I don't invest in hardware. It's driven by the fund side. So I've built an entire Fund 1 and now half of Fund 2 is a thesis driven on software companies, software and data analytics companies that are serving a climate vertical. So, and when I started, I was expecting that these would be all pre-revenue companies, but you can get a lot done if, one of my companies does data analytics for flood risk, and it's he used to work for the European Space Administration. He designed a clever, antenna that can see satellite transmissions and see how they bounce off water, and he can measure water levels to millimeter level accuracy. It's printed circuit board assembly and an antenna and array, and that was the technology. That wasn't. So you'll hear of something called an MVP, minimal viable product. He still had to build out a whole back-end data lake, data analytics tool, but it was enough that he could start, selling the data acquisition system to water utilities and to property owners to get alerts for flood and that kind of thing. And so for a seed stage round, there were still, I think it was like 6 customers or something, but and I'm not looking for, it's sort of, I describe it as like a seed stage company to me is one that's got some market traction, some customer validation, but not a functioning revenue engine. So a functioning revenue engine is you're serving these customers and you know who they are, and now you're growing more and more customers of that same vertical. That's what you need for a Series A, which used to be $1 million in revenue. Now it's kind of like $3 million in revenue before raising a Series A. Whereas a seed stage investment, at least for me, is you don't need to have that revenue engine going. In fact, I'd rather invest when you didn't, because you would have a valuation that reflects that you don't have that. There's nothing wrong with having that in place, but then you'll be too expensive for me. But still, you'll have some customer validation to show that there is something there. And that a low capex solution, it doesn't have to be explicitly software, but some printed circuit board assembly, something that doesn't require. But if you've got a new reactor chemistry for making processing iron slag, and your first installation needs to be $100 million, then I can be of no help to you. And there are larger funds OGCI, Oil and Gas Climate Initiative, I think has a $2 billion fund. Amazon's pledge fund is $2 billion. Breakthrough Energy Ventures. These are multi-billion dollar funds, and they are happy to write very big checks. But then you would have to appeal to a fund like that to back a technology like that. Whereas something that requires less capital opens up a greater suite of investors who can participate simply by for virtue of the fund size. And something that happened accidentally in parallel was, and I loathe the term, but I'll use it because everyone uses it, the rise of the micro VC. And a micro VC is deemed to be 50 million or less in assets, which doesn't sound very micro to me, and I find it pejorative, but whatever. But that happened, and it was a bunch of prior entrepreneurs mostly entrepreneurs, who then went and raised $10, $20 million funds. And back in the day, and by the day I mean 2012, a VC fund was Kleiner Perkins with $1 billion under management, or Sequoia, or all these multi-$100 million funds. And that has changed, that there's so many more investors with smaller funds, but that only helps you if you're the kind of an entrepreneur who can accept a smaller check. But that has proliferated in the last 10 years, which wasn't the case prior to 10 years ago. That's sort of my observation of what's happened.
Well, if the micro VC is 50 mil,
Yeah.
I usually ask them and say, in what currency? We will see. I mean, US dollar? Wow.
Yeah, US dollar, 50 million is considered a micro VC. I think that term was created by Andreessen Horowitz and 32, large, I think they have 32 billion under management. Very large VC firms have an incentive to create pejorative terms for small firms. So that's where I think is where it came from, but whatever. I'm the one still saying it, so I suppose it's my fault too.
Okay. So we maybe take a wrong term. That now sounds like it's very hard to get money, right?
Incredibly hard to get money.
Okay, but we are here because in the audience we have lots of entrepreneurs, we have students, we have professors, they have technology, we have solutions, we target the great markets needs that we want to push our technology forward that have become commercial successful, right? So from your point of view and your experience, maybe this is more helpful for everybody here is what kind of support system, or even here in LA, what kind of ecosystem we actually are helping entrepreneurs to be successful? Maybe you can give some examples, or your personal example, or something. Yeah.
So one thing you should remember is the investor should be the last person you care about. In fact, if you do it right, Atlassian, I think, what's his name, the Aussie guy, he owned like 80% of the company upon IPO. I mean, you raise money because it gets you somewhere you could not get otherwise. But the person you really care about is your customer. If you have a customer who loves what you're doing, I don't want to say raising money will be easy, but that solves a big chunk of the VC due diligence. The VC's like, I don't know what you're doing, but someone who does know what you're doing is paying you money, so that's good enough for me. The investor shouldn't be the tail that wags the dog. The market and the customer and growing a business should be the primary pull, and then investors will want to support that. So that is difficult to do if you're, have some large first-of-a-kind project, but that should be the main focus of who you're chasing, and then everything else comes from that. And that isn't entirely what you asked, but I did want to say that, so you can say it.
You want to go? No, go ahead. Okay. There's actually quite a great ecosystem, support system for startups, and you should definitely take advantage of it. There's everything from accelerators. UCLA has the Anderson Accelerator. There's, I don't know the names of the other ones, but there's like 3 or 4 other accelerators on campus from different schools and different purposes, and definitely want to use those resources, those mentors, those people who have experience who can help guide you. In Los Angeles, there's LACY, the LA Clean Tech Initiative. There's
Incubator.
Sorry. There's similar Greentown Labs in Boston and Houston, and they are, the fact that you're local here is great, but you can apply to the one in Boston, you can apply to the one in Houston, no problem. There's other accelerators that I'm involved in. Clean Tech Open, CTO, is now taking applications. I'm a mentor there. There's hundreds of mentors, so it's a great nationwide program. I'm also at VentureWell, which has a couple of different hybrid programs that depend on what stage you're at. There's more general accelerators like Founders Boost, which helps you with your pitch deck.
Techstars.
There's Techstars, LA. There's Techstars in a lot of different places. So accelerators are one place to start. There are, if you're at the right stage, there are angel investment groups. Tech Coast Angels is the biggest group in Los Angeles. You can come pitch to us. You can reach out to the members for guidance on whether you're at the right stage to be pitching to us. There's Chemical Angels if you're specifically involved in chemistry and materials. That's nationwide. There's other angel groups that are focused on climate tech. E8, I think, is the biggest one. And then there's one in New York. I forget the name. Creo? Is that the name?
Creo is, I forget the acronym.
Yeah, okay. And they're specifically looking for startups in climate tech, both software and hardware. And then there's just a huge network of mentors. But as Aaron said, you got to start with the customer. So before you start talking to investors, you should be talking to 100 different customers at a minimum. Find out what they need. Find out if you can make it. Find out what they're using now, what their problem is, and how you're going to solve it. Because you got to figure all that out before you can go pitch your great idea.
Completely agree. To mention two more breakthrough, plug and play, have also accelerators. But overall, I think what I would recommend is make sure you go where your technology is going to be more favorable. What I mean by that is there is usually a location globally where there is going to be more innovation in your sector. LA is very much known for real estate, media. Houston is very much known for aerospace. In North Carolina, they're very strong in textiles. So if you just know your hub and potentially plan a trip to know exactly what is the most recent innovation, go talk to investors in these hubs. The second point are conferences. Conferences are expensive. So what I would recommend is selecting the top 3 based on what you do in your sector, but also know exactly who's in attendance. Look at what was the attendance the previous year. Look potentially, if you can, who's going to be attending this year. If you're raising, make sure that 25% of the attendance are investors who invest specifically in your round. If you're trying to find strategics or corporations, make sure there are corporations there. So in general, when you reach out, make sure there is a clear purpose so you can have the best result as possible.
All right. I mean, there also TTG will help you to license. And in fact, because they're connection in campus, they can also introduce you to certain advisors, mentor that be able to help you too. And I wanted, during your guys' talk, and inspired me that, in fact, in UCLA campus, there's an I-Corp program been running. And this is exactly what they do. If you go through the I-Corp program, either it's funded by NSF, the requirement is you need to talk to over 100 customers. And the government is paying for it. Why not take advantage of such a program that you can actually push your technology forward and by talking to the customer. And finally, that is currently open as well. School of Anderson, they have the cross-campus challenge. One of the topic is in the sustainability. And it's a business school event and Anderson Eastern Center. However, the requirement is they require a business school student partner with engineer, law, whatever college or school in campus. So they purposely call it the cross-campus challenge. So the team need to have a technology, business, everything covered, and it's open right now. Lots of people right now, maybe you want to check it out and submit the application. They actually give out small check, but in US dollar, and and that why not? And it's kind of a way to prove your technology as well. So the one thing that we actually did our homework and tried to prepare for this panel is try to bring the information forward that there is a supporting ecosystem here in LA be able to help. Meanwhile, we also want to leave more time for the audience to ask questions, and then we wrap up with the final thought. Okay? So is any questions? Oh, by the way, when the microphone migrate there, I just learned that Cal State Long Beach is thinking about start climate climate tech incubator or accelerator. So there's in the future maybe there's additional resource, right?
Mine is actually a pitch or an ask. My college is always looking for internships. We want to partner with a company that says if you teach your students these particular skills, they're employable and we are ready to give them paid internships in return for taking the class. Do you have any, that kind of programs going? Or anyone who does would like to partner with the community college to offer those opportunities to marginalized students who are not exactly who need jobs, but who are not ready in the workforce, but who would be incentivized to work if they had that training and if anyone in the industry was ready to offer those paid internships.
So, most VC funds, well, I guess it depends on the size of the fund and the resources they have. Thin line capital and a lot of funds my size don't have a specific program for that. We're just focused on trying to find companies and supporting them. The companies within my portfolio, one thing that VCs try to do is try to find opportunity, if those companies are hiring, to help match up people to those companies. Now, the challenge with startups is their hiring cycles are really volatile. A large company can smooth out hiring cycles, whereas a startup might raise money and immediately hire 10 people and then not hire anyone for a while and then start run low on cash and then let half of them go and then try to eke out runway to raise more money. And so startups have the volatility of hiring because they've got no inertia, for like to use a mechanical reference, if there's a lot of mass in the startup, then it has some smoothing, but a startup is very light, so it can be quite volatile. And so I know even the companies that I invest in, some of them hire summer interns, some of them don't, because they're trying to figure out how they can, especially seed stage, where it's a lot of proving market traction. Series A and later companies which have that flywheel running are more likely to have internship programs. I mean, I'm just kind of going off of the companies that I'm involved in. I don't know what the stage that you guys see.
No, we completely agree with you. In general, it's risky to be part of a startup. It's also generally very rewarding because you just don't do one thing. You do 1,000 things that is under one role. But maybe what I would recommend is one, usually in the portfolio. So if you go into a VC website, you'll see the portfolio companies. Usually you can potentially see if we personally have a page with all of the openings from our portfolio companies. So that's a place where you can potentially look for internships or even job opportunities. And in terms of investment, and I'm sure I can talk to all VCs, usually there is a relatively strict thesis. So we invest, for us, we invest in deep tech companies that have a certain threshold in environmental impact and that have costs that are better than what's currently on the market. That is so specific that I will only look at these companies in that space. But if you're looking for investment, I would look for thesis that match exactly what you're doing, more maybe towards social, trying to see who invests in what you're looking for specifically, because you're going to get more responses that way.
So here's my recommendation. If you can find a job that's already existing where they're already looking for somebody, that's great. That's kind of a little bit of a challenge to be going through one by one, all the different startups. There's at least 3 job boards for the climate space. One is called MCJ, My Climate Journey. There's another one called Climate Base, and the third one, I'm blanking on the name. They've each got on the order of 10,000 people signed up. It's mostly on Slack, and a lot of it's very early stage. A lot of it's people who want to get into climate. A lot of it is people who have some idea, don't know what to do, and some of it is very early stage startups. Some of it's medium stage startups looking for hires. It's just kind of the whole network is kind of there, and I think MCJ also has a lot of seminars and Zoom events nationwide, as well as I think in-person events in some places. So my recommendation is tell them to go on those boards and post what they're looking for. There's a whole channel on jobs or hiring, but then they don't have to restrict themselves to that. They can say, well, here's who I am, introduce themselves, here's what I'm looking to do. Is anyone else, can I be of help to anyone? You can do that as a professor. You could jump on there and say, hey, I've got 20 students who are looking for these opportunities. Is anybody, take advantage of it? So I think that's a good way to get in front of a very large audience at one time. So I would start there.
Thank all of you for the great panel today. Just wanted to follow up and ask, with the recent change in the administration policy priorities, et cetera, has this, can you articulate as to if this has had changes sort of with respect to your the limited partners in investing in your funds, et cetera, or change the sort of investing environment in that respect? And what are your recommendations for entrepreneurs now who are trying to raise sort of in this new reality going forward?
Okay, so I was with you until you mentioned LPs. It's 3 weeks. It doesn't feel like 3 weeks, and my house almost burned down in the middle of it and everything else. So there's been a lot going on, but it's only been 3 weeks. So to understand, a venture capital fund, it's not our money, by the way. This is something I didn't appreciate as an entrepreneur. Like, why wouldn't you invest in me? It's like, because it's not our money. We went to other people and sold them a thesis. We said, hey, we're going to invest in these things. The people who invest in a VC fund are called LPs, limited partners. So the ladder goes LPs to VCs to entrepreneurs. So it's only been 3 weeks. My LPs have all asked me, hey, is this going to affect your thesis? How are you going to respond to this? Blah, blah, blah. So I've given them my thoughts, which I'll give you now. But I don't know if we can say that's affected the ability of VCs to raise money from LPs, because it's only been 3 weeks. Now, how has this affected me, my thesis? I looked at a number of companies that were providing analytics software for corporates to meet SEC compliance for scope 1, 2, and 3 emissions. I never pulled the trigger on any of them, but there was a couple I really liked. I'm not going to invest in those now. The SEC is obviously not going to be pushing. That's a policy-driven thing. I know that California is still doing their own things, but it's just hard for me to see how that's going to happen. One of my companies had a $5 million DOE grant. It the check did not cash. No one knows if it'll be paid. They're probably going to smash into a wall. So that company's gone. You talked about support for the ecosystem. 6 months ago, I would have said DOE grants, RPE grants, SBIR grants. I can't say that. I can't say that that's a good strategy based on the last 3 weeks. 3 weeks from now, everything could have pivoted again, and it's a great strategy. But I'm just saying that is a highly uncertain path forward, given what's happened. And so what I've told my LPs is like, look, independent of everything that's happening, EVs, electric vehicles, are reaching cost parity with internal combustion engines. And the global market is absolutely moving forward. China's already well past that point, so we're parts of Europe. And so I don't see that changing. The senior VP at Nextera, which used to be Florida Power and Light, basically said, okay, that's nice and all, but we have to buy the cheapest and fastest sources of energy to deploy, and so we're going to keep buying wind and solar. We'll get sued otherwise. So the market momentum for renewables, for EVs, for these sectors is bigger than policy now, for sure. Maybe back in 2006, policy drove a lot of that, but that's moving forward. Solar is the cheapest form of energy generation almost everywhere in the world. And so my thesis hasn't eroded, but certain sectors. I invested in a geothermal company. I'm really glad I invested in a geothermal company because that seems to be, we're drilling holes in the ground and hiring all sorts of oil and gas guys. That's a sector that's probably going to have a lot of support. I think nuclear will as well. So it's shifted some of the things versus others. By the way, AI, data centers, anything that can power a data center. I mean, Constellation repowered 3 Mile Island just so Microsoft could run a data center off it because the electricity draw of data centers and what AI is going to do is staggering. And so solutions that can solve that, those are all going to continue growing. So there will be winners and losers, and investors are going to have to adjust accordingly, but getting grants is going to be harder. Policy-driven businesses are going to be harder. And that's sort of how I see the way things have panned out. I don't know.
So as an investor, and I think it's not how all investors think, but is pretty common in my group at Chemical Angels, is when we look at a pitch, we look at the techno-economic analysis and we say, does this make sense? Is this going to be more cost efficient than the existing solutions out there? Or if not, is there a market that's going to pay for it? And we basically ignore the political environment because the political environment can change. Now, SBIR grants, well, that's a difficult topic, but at least when you come to the investors and say you should invest, $2 million or $5 million in our business, you need to show why that is going to be cheaper, better, or for some reason somebody's going to buy it, other than it's just better for the environment. And unfortunately, that means a lot of the solutions when it comes to like recycling, when it comes to manufacturing of things, plastics without using petrochemicals, becomes very difficult. But even with some incentives, it's still, you may have incentives in the US, but is that going to apply to Japan? Is that going to apply to Europe? Who knows? And in the end, the customers, for most of these things, is going to buy the cheapest thing they can get, whether you like it or not. Except there may be some markets like cosmetics where the consumer may say, yeah, I want something natural. Okay, well, then you got to be talking about that market, not just the fact that you have something that is better for the environment. So again, it really comes down to the customer, and you need to prove to us that this is the best product, the best production method, regardless of, whatever government incentives are out there this week or this month or this year or the next 4 years.
I'll try not to repeat what you both said, but first of all, the LPs, I completely agree with Aaron. Especially, I think our LPs, they won't have an impact on the environment. And so whatever is going on in terms of the government, they want to be able to have that impact through our investments. So we don't see a change there. They are worried. We definitely have some questions there, but in terms of they're not going to pull back or anything like that because of this change. And something that DC just mentioned, it changes. Policies changes. Our fund is 5 to 10 years, like most funds. In 5 to 10 years, our companies are going to be at a stage where it's going to be different again. And I think Aaron said it very well in terms of shift. I think we are just seeing shifts. And I think our thesis just need to be aware of that shift, and we need to invest in smart. What I mean by that is we looked at regulations quite a bit when we were focusing on a few sectors such as sustainable aviation fuel. Well, now we have to be aware, okay, are regulations still going to go through? Because if it's not, maybe the adoption, the customer is not going to want to pay twice as much for the same product. So I think at the end of the day, and you both said it, it comes to adoption of that customer. And there are some times where policies and regulations are going to really help and support, and sometimes not. And our thesis needs to always take that into account. And now we're at a stage where we can't, when we think about adoption, we cannot just think about policies and regulations, because that's not where we're at today, unfortunately.
All right. In that case, that we are between the dessert networking time and the panel right now. So if you have one thing that you want to advise the entrepreneur, the student thinking about start a company, the professor have a great technology, and they want to commercialize it, what is the one thing you want to provide?
Okay, well, so iCore, somebody mentioned iCore. It's a really great. I was a lecturer when I was getting Thin Line going. I worked and was an adjunct lecturer with iCore, and one of the it is kind of like a boot camp. But every company that came up, the first question was, what do you do? Who is it for? And why do they care? And I was like, wow, that's really good, because it's totally good. I mean, like, we make this filtration system, it's for these industries, and they care because it lowers the cost of their production by 20% or something. Like, it immediately frames what you do, who is it for, and why do they care? Because the why do they care is the value, the who is it for is the customer, and what do you do is the technology. And I just thought, and so nobody pitches to me that way. I've seen 1,500 companies, and I've invested in 14. So that's like roughly 1 in 100. And I have to ask them, like, okay, I'm sorry. Like, I'm sorry, what are you doing? And who's this for? And why do they care? And I think it'd be really great if more and more pitches were like that succinct, because the rest of it is diligence. But if I know what you do, who is it for, and why do I care, like right away I can know whether this is something I should spend time on or not. And anyway, so that's my request.
Be concise and data-driven.
That was very concise.
Do you have any data that shows that?
All right, I'm going to be a little long-winded, though.
Well, you got the time now.
Yeah, so I have a very simple answer that takes a lot of context. So my answer is, think through whether you really want venture funding, and that includes angel investment as well. I've seen it's turned into this default of the way we build a business is we put together an idea, we put together a pitch deck, we go out and pitch to investors, they give us money, and then we build a unicorn, and then we're all off billionaires. And that's not the way that doesn't always work. And in fact, 9 times out of 10 or worse, that doesn't work. And I see a lot of great startups that, kind of back to what Aaron said at the beginning, that really that are great businesses, but they're not great investments. And so if they had gone out and built the business by, buying scrappy and getting customer prepayments and getting government grants instead of going out and getting venture investment, they would have actually been successful. They wouldn't have been billionaires, but they'd have a nice 10, 20, $30 million business. But the problem with venture capital is, and no offense to you guys, where angels are kind of in the same ecosystem, the way it works, if you're not familiar with it, is we don't get any return until the company is acquired or goes public. And that's not going to happen at good multiples unless you're somewhere in the $100 million revenue range or not. And getting $100 million in revenue is really tough, and they've got a 5 to 10 year time frame. So you need to get to $100 million in revenue in 5 to 10 years, maybe 12 years. That is a tall order. Now, if you're inventing a new nuclear power plant, absolutely, we're talking tens of billions of dollars. If you're inventing a new battery chemistry, that's billions of dollars. If you're inventing a new way to make the graphite that goes into the batteries, that's probably, well, that could be a $100 million business. But you're going to have to do the manufacturing yourself. So you're going to be a manufacturing company. Instead, you take that great technology that you've invented and license it to the companies that manufacture the graphite, and now they can make it better, faster, cheaper, and they'd pay you a 2 to 5% licensing fee, and then you've got something like $10 million coming in every year with almost no other expenses. That's not a bad business to be in, but that's not a venture business. So when you're pitching to investors, you need to think through, how am I going to get to $100 million in 5 to 10 years, and then have somebody acquire me for $1 billion. And if that's your business, great. Go, then that's a venture business. If it's not, then instead of wasting your time trying to look for venture investments or trying to find ways to make your market seem larger than it really is, find another way to build the business. And there are other ways of doing it and different ways of financing it that may be suitable for your business. So don't think the way to go is always, let's go find venture investors and build out a venture business. So think it through beforehand. How big's the market? What do you want to do? Do you want to be a manufacturing business? Do you want to be a licensing business? Do you want to have a bigger chance of success at a smaller scale, or do you really want to go for that, let's be the one out of 100 that gets to billion size and the other 99% explode along the way? That's a choice you need to make, and you really should be thinking that through from certainly before you start pitching to investors, but probably from the very beginning of what is the product, who are the customers, and what is going to be the best way of serving them, and then what is the best way of financing that.
All right, that's it. This is all the questions the AI helped me generate. I asked all of them, and thank you very much.
Thank you.
Thank you.